Good morning, everyone. Today we're going to be reviewing the morning session of the NASDAQ futures contract. Here we have the daily chart. I want to note out the daily volume imbalance we have right here, highlighted in yellow, and our new week opening gap here, here, two pink lines. It's going to be our draw on liquidity for today. Now we'll get into the 1 minute chart. We have our market open here at 9:30, the opening price. Price drops below it, takes out short-term lows here, and then it rallies higher. We also want to note regular trading hours. You see we have this large gap, price gapped up today, and it did not get to the consequent encroachment of that. So our 50% level, price was not able to go down into it. It didn't even get into this upper quadrant here before rallying, just showing that price is bullish. Okay, so we have our 9:30 open and price drops, taking out short-term lows, rallies higher, creating a market structure shift right here. When it crosses this, we have a market structure shift bullish. And as we take out that high, we create our first presented fair value gap right here. Now price doesn't return back into it, leaves it unfulfilled, which also supports the narrative of price going higher today and drawing towards the daily volume imbalance, highlighted here in yellow. We rally higher and we come back into this fair value gap here, and we can see the bodies are respecting the consequent encroachment, and the wicks are coming down and just tapping the bottom of that. And we're doing this right at the 10 o'clock macro between 9:50 and 10:10. It's our 10 o'clock macro. So right here is a good area to be buying long, expecting price to rally up into the daily volume imbalance. So if you were to get in right here at the top of that fair value gap, your stop loss would be underneath it. There's a little fair value gap right here as well, and you want your stop loss to be underneath that. So 20-point stop loss. And if you hold on to your target, almost 100 points. You can get 95 points from that trade, just inside that 20-minute time frame of the 10 o'clock macro. Now you'll notice that price falls short by one tick. So it's 18,306.25. Price goes up to 18. If you look up here at the high, 18,306. So it falls short by just one tick. That's why if you're trading with only one contract, you want to take profits early and not force yourself to be so precise. Just take the profits as they come. So you'll see price rally, and here these blue lines highlighting a 15-minute fair value gap that gets created. Right here. So inside that 10 o'clock macro, we create this 15-minute fair value gap from the high there and the low there. And you can see price just barely ticks into it. So if you missed this initial trade, price comes up and it doesn't get into the daily volume imbalance or the new week opening gap. It falls short and it comes back down. Here would be another possible entry for you right there as price ticks into it. Your stop loss would need to be underneath the 15-minute fair value gap. It's about a 30-point stop loss and targeting just there for 65 points. Now, if you're trading multiple contracts, you can take a partial right there and have your final target closer to the consequent encroachment for about 100 points in profit. And you see price goes up, comes back down, and then rallies through it. That's going to be it for today, folks. If you enjoyed the video, like and subscribe, and I'll see you next time.